CPI came in at 3.1%, which is as expected, and it was largely driven by shelter inflation, which carries the most weight in the CPI data that the Bureau of Labor Statistics puts out. But when we look at some of the other categories like apparel, like food, like energy, those items dropped, a lot of them month over month. And it actually, if we look at the month over month CPI data, the change from October to November, that's not seasonally adjusted, the numbers show that CPI actually decreased by 0.2% month over month, which annualized would be a decrease of 2.5% roughly year over year if this were to continue throughout the year. And that makes a lot of sense when you think about what's going on with the average consumer out there, how a lot of that stimulus money has ran out, how student loans have started back up, how credit card debt is at an all-time high, and balance sheets are starting to decline. It makes sense that a lot of these items are going down, like apparel, like food. People have less money to spend, especially on items that aren't necessities compared to rent. When you think about what's going on with rent, and interest rates have been high for the past year or so. And because of that, it's harder to get loans. It's harder for builders to bring new inventory to the market. And so there's less inventory available out there. There's less homes available for rent, which is driving rent prices up. So what does this all mean for the home purchase market? What does this mean for you as a home buyer or home seller in 2024? Or where are prices going in 2024 in the US housing market? We're going to talk about those things here in this video. But first, my name's Liam O'Reilly. I'm a realtor here with Jerry Riley Real Estate in the state of Vermont. If you folks have any questions about real estate or any real estate needs at all, whether in Vermont or anywhere else in the country, reach out to me directly. I would be happy to help you. And let's get right into this video here. So this is the data directly from the Bureau of Labor Statistics website. And we look right at the top here, the unadjusted percentage change, 3.1%. That's the headline inflation that I mentioned at the beginning of the video. The core inflation is 4%. That's what the Federal Reserve looks at. And that's what holds the most weight with the Federal Reserve deciding on whether or not to cut rates or keep rates where they are or raise the rate. This is the number. That 4% number is what they look at, and they want to see that close to around 2%. Now, this is what I was talking about with the unadjusted percentage change, down 0.2% month over month. And you see that food is down 0.2%, cereal down 0.5%. And we scroll down here, energy is down 3.4% month over month. This is from October to November. So food prices are dropping month over month. Energy prices are dropping month over month. We have apparel down 3.5% month over month. New vehicles down 0.4% month over month. So many items are dropping month over month, not seasonally adjusted. Now, the seasonally adjusted data shows a bit of a different story, and there's arguments to be made of whether seasonally adjusted or not seasonally adjusted is better. I just think it's good to look at the unadjusted data because those are the real prices. That's what, when you go to the store, home food prices are cheaper than they were last month, at least according to this data. So when we scroll down here to the shelter inflation that I mentioned at the beginning of this video, it holds the most weight. 35% of CPI is shelter inflation. And we see year over year, it was up 6.5%. And it's up 0.4% month over month, non-seasonally adjusted. So in real terms, and 4% month over month, or 0.4% month over month, seasonally adjusted as well. So that's a big part of shelter inflation. And again, I think a lot of that has to do with where interest rates are. So the Federal Reserve is hiking interest rates to try to stop inflation, but at the same time, it's harder for people to get loans to build new housing, to bring more inventory to the market, both on the buy side and the rent side. So because of that, there's less inventory out there. There's less homes to rent, which is driving the cost of rent up as more people are competing for homes to rent, as there's more tenants out there who can rent homes. Rent is higher. And we're seeing that reflected in the data. So now there's some debate on whether the owner's equivalent rent of primary residences is an accurate depiction of rental CPI. And we could talk about that all day, really, but I just wanted to bring up this chart here, and this is from mishtalk.com. And this article's in the description if you want to read it for yourself. But basically, this tracks the blue line here, which is repeat tenant rent, so rental renewals. What's going on with the rental renewals in the market, and then what's going on with the CPI rent year over year. And you can see that overall, for the past few years, the CPI rent has been below the rental renewal rent, as tracked by this data up until recently, up until really the start of 2022. Now, we don't have the data for 2023, so we'll have to see how that looks. But I guess I'm bringing this chart up to show that there's at least some validity to the inflation numbers that the Bureau of Labor Statistics are talking about when they mention their rental inflation numbers. And again, this is really important because that's such a key factor into the CPI numbers, which is what the Federal Reserve looks at when setting their interest rates, and that's what affects you as a borrower, as a borrower of mortgages. So what's going on in the general economy? What's happening with CPI? Why are these numbers, why are these apparel numbers, why are the food prices, why are energy prices dropping month over month? Now, I think a big part of it has to do with the consumer, and we look at some other cases of CPI. Now, this is an interview from the CEO of Walmart, says that consumers may not be as resilient next year, even as deflation starts to show. So Walmart is saying that there's deflation throughout many of the items in their store. And we see right here in the highlighted section, deflation in some items is creating a new dynamic for Walmart. In general merchandise, the category that includes electronics, toys, and other non-food items, prices have dropped by about 5% compared to a year ago. So many items out there are a lot cheaper, and it makes a lot of sense when we take a look at what's going on with the consumer. This is a chart of checkable deposits, so checking and savings accounts at for U.S. bank accounts around the country for the average American consumer, and we can see that it's dropped off significantly from their 2022 peak. Now, it's still significantly above where balances were back in 2018 and 2019 before the pandemic and before all the stimulus checks went out and flooded consumers' pockets with money. But the average trend of this is down. So consumers have less money than they did last year in their checkings accounts. And we see that in consumer debt as well. The credit card debt is way up at an all-time high. And we're seeing delinquencies, credit card delinquencies rise. So as of Q3 2023, it's at 2.97%, which is higher than it was just before the pandemic at 2.76%. So really, the consumer's struggling, and they might even be struggling more than what this data shows. And a big reason for that is phantom debt. Now, this article talks about phantom debt, which basically is the afterpay programs that you see. Like I think there's a company called Afterpay. There might be another one called Affirm. These are just a few that I've heard of. I personally don't use their products myself, but a lot of consumers do. And essentially, this is the same thing as a credit card. You're borrowing somebody else's money and you're going to pay it off incrementally. Now, many of these companies, if you pay it off on time, there's no fees, there's no interest as long as you make your payments on time and you can pay off whatever you're purchasing. But for people who miss payments, there's steep fees, there's steep percentage, interest percentage that you'll need to owe with this debt. And so on top of the consumer debt that is being, that's at an all-time high, the credit card debt that is at an all-time high, there's also this phantom debt that is not tracked, that is unregulated. And we see right here that Wells Fargo economists analyzed the growth arc of one of the largest buy now, pay later providers and estimate loan values for 2023 will come up at around $46 billion worth of loans. Now, many of those loans will have been paid off, but still, we really have no idea where these loans are and how this is going to affect the economy, but we're seeing it reflected in the consumer. And I think it shows up in CPI. It shows up with what's going on at Walmart, with prices down 5% year over year for many of their non-food products, for many of their toys and things along those lines. People just have less money to spend. Generally, the general consumer has less money to spend. So what does this all mean for the housing market? What does this mean for home prices as we move into 2022? Now, I think there's a few categories of this. If you're a home seller, I think, this means that there's going to be less of those first-time home buyers fighting for your home. A lot of the first-time home buyers out there are renting and are really struggling with rental inflation. Rent is very high right now. And it's eating into a big portion of people's paychecks, and they'll have less money put down to purchase a home. And just like they have less money to go out there and buy clothes and toys and things along those lines, that excess spending money, it's depleting, and many of these consumers are struggling. Now, I do think that there's a lot of home buyers out there that are just waiting on the sidelines, waiting for rates to come down, waiting for prices to come down. And I personally think that's going to keep home prices relatively stable throughout most parts of the country as we move into 2024. Now, every market is different. There's not a national housing market, so your market may differ significantly from where I'm at in Vermont, but I think overall nationally and here in Vermont, we're likely to see home prices stay flat year over year as we move through 2024 because of how many buyers there are on the sidelines. Now, with inflation where it's at and with where the average consumer is, there might be less buyers than there were last year that are sitting on the sidelines because less people can afford to purchase a home. But inventory is still so low. And as soon as home prices start to drop even a little bit, or rates start to drop even a little bit, I think we're going to see those buyers jump at the opportunity to rush into the market and take advantage of these homes, of the prices and the increased affordability. So I think all of that is going to keep home prices relatively stable. And I say flat, maybe it'll go down a percent, maybe it'll go up a percent, but we're not going to see a huge 20% crash or 20% gain in home prices as we move through 2024. And I think a big reason of that is because of where the consumer is, where the US economy is right now, the stress that consumers are feeling, and sellers who have locked in at these lower rates and are going to fight to stay in their home. They're going to stop buying new clothes, they're going to stop buying new toys long before they give up that 3% mortgage rate because of how high rents are, because of how high rental inflation is. It's not cheaper for them to sell their home and go rent. It's not cheaper for them to sell their home and downsize into a higher mortgage rate that potentially could have a higher monthly payment. So anyway, I hope you guys got something out of this video. Thank you so much for watching. Leave a comment in the description. What do you think? Do you think I was spot on about what's going on in the economy and what's happening with CPI? I learned so much from you folks, and I love reading your comments. So please read me one or leave me one if you have an opinion. Other than that, thanks again for watching. And I'll see you in the next video.